Our second speaker in the inefficient asset class is Francesco de Juan from Alantra in Madrid. But like all Aussies do, we've shortened his name to Paco, so I'm looking forward to introducing Paco to stage. Alantra won't be well known to many of you, but it's highly regarded in Europe for its constructivist approach to investing, and Paco has been leading their listed equities business there for about 15 years. He also lectures at the IE Business School in Madrid on active ownership and the role it has to play in influencing boards and executive. The strategy's delivered 12% per annum since inception over 15 years ago, in spite of the major headwinds in Europe and the fact that small caps have struggled to outperform large caps. Anyone in the room have a standalone European equity allocation right now? Show of hands. Anyone travelling to Europe in the next 6-12 months? Yeah, so we're all good at that bit, not so much on the other side, but clearly today one of the challenges is to think about some of these areas where we've got defence spending and some big changes in the environment and whether or not it's actually worth our attention. To that extent, we are pressing on with launching a European small cap strategy, and we'll tell you a little bit more about that in the months to come. So Paco's job today is to convince you that maybe it's time for Europe and small caps might well be worth your while. Please put your hands together for Paco. Thank you, sir.
Thank you. Hello, everyone. My pleasure being here. I'm an active investor. There's a lot of things going on in Europe. It's an environment where there's been quite a lot of pessimism around. And I'm here to give you a bit of an alternative that you could benefit from what we think is going on, particularly as the wind might be blowing in a different direction in the years to come. The first point and basic is the European small caps. That is a very interesting space. It's very attractive. It's very ample. There's a lot of companies. There's a lot of quality companies. And it happens that there's very limited analyst coverage. So it's a very good place to fight inefficiencies and dislocations. Equally, it is a space where M&A takes place and you can crystallize value. And ultimately, it is a place where you can engage with CEOs. You typically operate with first-time CEOs. So it is a very good playing ground to source value dislocations, to help the companies, and to eventually crystallize them. We've seen in this space a massive dislocation over the last few years. In absolute terms, so just to give you a reference, the small cap European market used to trade 15, 16 times price earning ratios over 30 years. It is trading at 12, 13 today. Small caps used to trade at a premium to large caps in Europe, and we're trading at a discount. And this is all related with what has happened after the Ukraine war, with rates going up and people switching to liquidity. No? And that is a situation we're certainly living through. As a consequence of that, we're experiencing a tremendous dislocation in certain areas. No? And that could vary. There's some countries like UK, there's some countries like Germany, like France, where we're seeing big dislocation. And there's some industries, like some places like industrials, where that, because of the energy issues we've been facing, the dislocations are even greater. No? When it comes to our portfolio, we are seeing that we're touching it with our hands. No? We are sitting in quality companies which have a global exposure, and we can really see 7, 9, 8, 9% free cash flow yields in a short period of time. When we look into our prospective returns, we're looking into 20% type of prospective returns, and we've been doing this for decades. And we typically haven't seen that return profile for so long. No? So this gets a pretty good downside-upside equation for this universe and for this asset class. No? I would argue that small caps over the long run outperform, particularly in Europe, large caps. Of course, the return dispersion is pretty high, and as a consequence of that, if you're good at stock picking, and if you're actually good at improving companies, this is a very good place to have alpha generation over a period of time. Now, of course, for that alpha generation, you need certain processes. You need certain process to find certain assets, and you need certain process to help those assets and eventually crystallize value, no? In our particular case, we have a view towards the best way to do this is looking for quality companies. Now we look for companies that can achieve high return on capital over the long period of time. They can redeploy capital in a nice, over 20% in a long period of time. We look for global leaders. So, the last thing I'm coming here to Australia is to say European growth is going to be fantastic. No, what I'm trying to say is we can find beautiful global businesses in Europe that can compound growth over time, and they have global footprint, and they're well suited for what's going on globally, but you can buy them at a discount, no? And that intersection of quality, growth, and free cash flow is where we look for. The second thing is the active engagement. One thing we try to achieve is we invest in companies between €500 million to €1 billion market cap. We underwrite those investments over 6-8 years, and what we try to achieve is improving those businesses from a small cap to a mid cap. And by virtue of doing that, we not only obtain the value creation of those businesses in terms of earnings growth, cash flow, but when you get a small cap to a mid cap and it gets into the regional indexes, then you got ETFs, liquidity, so you get multiple re-rating, no? So the whole game of starting with a quality business that can compound, that can use its balance sheet efficiency, it gets you fundamental value, but as you step up from a small cap to mid cap, you got a lot of tailwinds that helps the multiple. And eventually, M&A, it is a critical element to boost those returns, no? So as we stand today, from a fundamental standpoint, macro has been a sort of a headwind of the last few years. Earnings cycle across most of the companies we're seeing are below normal levels. Multiples are sort of below historical levels, and the M&A is below, no? So we don't need all these things playing to have good returns, and eventually have some tailwinds. Well, we could have very, very good returns. Finally, and I think I've shown before, we have started to see some inflows in Europe after 7 years of outflows. I think I saw it here, no? So we've been operating in an environment where the money has been going away from Europe into other places. We saw for the first time in May this year inflows in the region, no? So with this sort of KPIs, a lot of them below normal levels, if we finally see, people thinking a bit more constructively in Europe, it could be a very good complement what otherwise is a good fundamental story. So with this, I leave. I hope it's interesting. Happy to follow up later. Thank you.